The sunk cost fallacy, the tendency to continue investing in a decision due to past resources, unlocking the secrets of rational decision-making. Have you ever found yourself stuck in a situation, pouring more time, money, or effort into something because of the resources you've already invested, even though it no longer makes sense to do so? This phenomenon is known as the sunk cost fallacy, a cognitive bias that can lead to irrational decision-making and significant losses. In this article, we'll delve into the world of sunk costs, exploring what they are, why they happen, and how to avoid falling prey to this common pitfall. What is the sunk cost fallacy? The sunk cost fallacy describes our tendency to continue pursuing an endeavor that we have already committed to in terms of investing money, time, or effort, even if those costs are not recoverable too. This bias occurs because our emotions often cause us to deviate from rational decisions. Abandoning a project after committing to it and investing resources into it will likely cause negative feelings of guilt and wastefulness. Since we want to avoid negative feelings of loss, we are likely to follow through on a decision that we have invested in, even if it is not in our best interest. Why does the sunk cost fallacy happen? The sunk cost fallacy occurs because our emotions often cause us to deviate from rational decisions. Abandoning a project after committing to it and investing resources into it will likely cause negative feelings of guilt and wastefulness. Since we want to avoid negative feelings of loss, we are likely to follow through on a decision that we have invested in, even if it is not in our best interest. Examples of the sunk cost fallacy. The sunk cost fallacy impacts various aspects of our daily lives, from education choices to day-to-day decisions like attending a concert or watching a movie. For instance, education is a billion-dollar industry in the US, and often we are asked to pay for educational programs in advance. Once we have paid for a particular program, we are unlikely to drop it even if we find a free alternative with a better success rate, because we have already invested money into that program. Similarly, the sunk cost fallacy also impacts smaller day-to-day decisions, like continuing to watch a movie even if it is boring. We are likely to continue watching a movie if we've invested both time and money into it, even though those investments cannot be recovered by continuing to watch the movie. How to avoid the sunk cost fallacy? Since the sunk cost fallacy is thought to be caused by our desire to avoid negative emotions, we should try to take our emotions out of the equation when making a decision. However, emotions are powerful and hard to ignore. Instead, we may want to use technologies to help us make decisions when it comes to scenarios where the sunk cost fallacy might influence us. Systemic effects of the sunk cost fallacy. The sunk cost fallacy not only has an impact on small day-to-day decisions, but also on the decisions that governments and companies make. The Concorde fallacy is a famous example of sunk costs impacting large-scale decisions. In 1956, the Supersonic Transport Aircraft Committee met to discuss building a supersonic airplane, the Concorde. Despite the project's increasing costs and the financial gains not offsetting them, the project continued because the manufacturers and governments had already made significant financial investments and dedicated a lot of time to the project. How the sunk cost fallacy affects product development. In creating and selling products, deciding whether to continue or back out of a project is challenging, especially when time, effort, and money are poured into a specific venture. By the rules of the sunk cost fallacy, one may prefer to continue with a project, knowing that it may not be the most profitable or successful if the alternative is giving it up. Why is the sunk cost fallacy important? The sunk cost fallacy impacts many aspects of our daily lives, as well as bigger decisions. It is essential to be aware of the sunk cost fallacy and how it can impede productivity. Managers and product designers must be able to recognize when a project isn't going as planned and when they must make the decision to discontinue ideas when appropriate, regardless of what they have already invested. Investing and the sunk cost fallacy. Investing is inherently forward-looking. Whether you're saving money in a savings account, putting it in the stock market, or investing in your own business, you're likely thinking about accumulation, future gains, and growth. Sometimes these investments don't pan out. That can hurt, but what you do afterward matters a lot. throwing more money at a losing investment, trading strategy, or business idea in the hope of justifying money already spent can open the way to bigger losses. 3. Conclusion. The sunk cost fallacy is a cognitive bias that can lead to irrational decision-making and significant losses. By understanding what sunk costs are, why they happen, and how to avoid falling prey to this common pitfall, we can make more informed decisions that are not influenced by the fear of loss. Remember, the amount you already spent must be viewed as irrelevant to what comes next. It's essential to reframe these sunk costs as just that, money already spent that cannot be recuperated. For clear and rational decision-making, it's crucial to completely disregard how much you've already invested so that it doesn't hold influence. For more such articles, subscribe to our channel. We upload new videos every day related vast subjects like human behavior, health, etc. You can also visit us on our website, askwebmen.com.